A sloth, a donkey, and a curious human. Send a prompt and see what they're doing. One hits record with a question on his mind. Two brothers pick it up, see what they find. Corn takes his time, Herman's got the facts. Back and forth, they never hold back. My weird prompts, come on in, that's where we begin. My weird prompts, glad you're here.
This episode was generated using artificial intelligence. Please verify facts.
My Weird Prompts is a community-driven initiative exploring how AI can fuel curiosity and uncover the fascinating ways our world works. GPU compute for this podcast is generously provided by Modal. Learn more at modal.com.
You know, we spend so much time talking about the founders, the celebrity CEOs, and the high-profile venture capitalists who get all the glory in the tech world. But there is a silent class of people who actually decide which of those industries get to exist and which ones starve. Today's prompt from Daniel is about the limited partner, or the LP, and it is honestly the most influential job title in finance that nobody ever talks about.
It is the ultimate invisible hand, corn. I am Herman Poppleberry, by the way, for anyone joining us for the first time. I have been diving into the data on this, and the scale is just staggering. We're talking about the pension funds, the sovereign wealth funds, and the massive endowments that provide the actual fuel for the entire private equity and venture capital engine. Without the LPs, the general partners or GPs are just guys in nice vests with expensive slide decks and no actual money to deploy. As of today, March 24, 2026, these state-owned investors and public pension funds are managing a record $60 trillion globally. To put that in perspective, that is more than double the entire annual gross domestic product of the United States.
It is funny you mention the vests, because the power dynamic has shifted so hard in the last year. For the longest time, the LPs were treated like passive check writers. They were the quiet money in the room. They would commit their capital, wait 10 years, and hope for a big return. But that room has changed, hasn't it? The quiet money has started shouting, and they're shouting about one specific acronym, DPI.
DPI stands for Distributed to Paid in Capital. For years, the industry was obsessed with IRR, the internal rate of return. IRR is basically a fancy way of showing on paper how much your investments have grown, but it is highly sensitive to timing and can be easily manipulated by fund managers using subscription lines of credit. But you cannot pay a retiree's pension with on-paper growth or a high IRR that hasn't been realized yet. You need actual cash. And with the exit backlog for private companies currently sitting at an estimated $100 billion, LPs are finally putting their foot down. They are telling the fund managers that if they want a check for their next fund, they need to show the cash they returned from the last one first. It is a cash-on-cash mandate that is starving the underperformers.
It is the show me the money phase of the cycle. I love that Daniel brought this up now because we are seeing this play out in real time with some massive players. Take CalPERS, the California Public Employees Retirement System. Just last week, around March 17th, they reported deploying $24 billion into private markets in a single quarter. That includes nearly $12 billion in private equity and $6 billion in private credit. When a $600 billion whale like CalPERS moves, the entire ocean feels it. But they're not just tossing money into a black hole anymore. They're being incredibly strategic about where that liquidity goes.
They have to be. This is where the liquidity realignment comes in. There was a survey from Adams Street Partners just a few days ago, on March 16th, where 90% of LPs cited limited cash flow as the primary driver for their 2026 allocation decisions. Because they are not getting cash back from their old investments due to the frozen IPO market, they are forced to rethink where the new money goes. This is driving a massive pivot away from those $10 billion mega buyout funds and toward the mid-market.
Why the mid-market specifically? Is it just a matter of smaller checks being easier to write when you are strapped for cash, or is there a deeper structural reason?
It is both. Mid-market companies are often easier to exit. You can sell a $500 million company to a larger strategic buyer or another private equity firm much more easily than you can exit a $20 billion behemoth in a shaky IPO market. LPs have realized that the mega funds are where their capital gets trapped for 12 or 15 years. In the mid-market, the cycle is faster and the DPI comes back sooner. It is a survival mechanism for the LPs who have to meet their own payout obligations every month. If you are a pension fund like the Caisse de dépôt et consignations in France, that is KESS, de dépôt et consignation, you have millions of retirees counting on you. You can't tell them their check is delayed because a tech unicorn hasn't gone public yet.
I also want to touch on the denominator effect, because I think it explains a lot of the hidden stress in the system. For our listeners who might not be deep in the weeds of institutional allocation, it is basically a math problem. If you decide that 15% of your portfolio should be in private equity and 85% in public stocks, and then the stock market takes a dip, suddenly your private equity holdings look like 20% of your total pie, even though you didn't buy anything new.
That is exactly what creates the paper over-allocation. When the public markets are volatile, LPs are forced to stop committing to new private funds just to keep their ratios in line with their own internal rules. It is a bureaucratic trap. And what we are seeing in 2026 is LPs getting much more aggressive about managing that trap. They are not just sitting around waiting for the markets to recover, they are turning to the secondaries market as an exit valve.
Daniel mentioned that the secondaries market is projected to exceed $225 billion in volume this year. That is a massive increase. Basically, if an LP like a university endowment needs cash and their money is locked in a venture fund that won't see an exit for 5 years, they sell their seat in that fund to someone else, usually at a discount. It used to be seen as a sign of distress, like a fire sale, but now it is a sophisticated portfolio management tool.
It is becoming a primary market of its own. We are seeing new types of buyers enter the secondary space who are happy to take those positions because they get a shorter duration and more visibility into what the assets are actually worth. But the real tension right now isn't just about selling old interests. It is about how the GPs are trying to keep the good assets for themselves through continuation vehicles.
I have been following the drama around those, and it feels a bit like a shell game, doesn't it? A general partner has a great company in an old fund. The fund is reaching its 10-year limit and needs to be closed out. Instead of selling the company to the highest bidder to generate that DPI we talked about, the GP creates a new fund, which they also manage, and sells the company from the old fund to the new one. They tell the LPs they can either take their cash now, often at a price the GP determined, or roll their interest into the new fund.
It is incredibly controversial. On one hand, it allows the GP to hold on to a winner and keep growing it. On the other hand, the LPs are asking if the price is fair and why the GP gets to start a new fee clock on the same asset. It is essentially the GP saying, "Trust me, I know this asset better than anyone," while the LP is saying, "I have been waiting 10 years for my check, please just give it to me." This tension is why the Institutional Limited Partners Association, or ILPA, is becoming so important. They are the ones setting the rules of engagement for these conflicts.
Right. Daniel pointed out that ILPA just launched a major reporting refresh on March 5th. They are standardizing how GPs have to report operational data. This is a huge deal because, historically, fund managers could be pretty opaque about what was actually happening inside their portfolio companies. They would send over a glossy PDF once a quarter with some cherry-picked metrics. Now, the LPs are demanding granular, standardized data. They want to see the same metrics across every fund they invest in. It is a move toward radical transparency.
It is the professionalization of the LP. They are no longer just looking at a quarterly report. They want real-time data feeds. They want to know the unit economics of the startups they are indirectly funding. And if a GP refuses to use the ILPA template, they might find themselves at the bottom of the pile when it comes time for the next fundraise. This is especially true as we see the rise of the sovereign wealth funds becoming more active and demanding.
This connects back to something we discussed a while ago in episode 1488 about sovereign wealth being weaponized. These players, like Mubadala, that is Mu, BAH in Abu Dhabi, or GIC and Temasek to MAH-SEC in Singapore, are not just writing checks to Blackstone and KKR anymore. They are doing direct co-investments. They tell the fund manager, "We will put $500 million into your fund, but only if you let us invest another $500 million directly into your best deals without paying you the usual 2 and 20 fees."
It is a brilliant move. They are leveraging their scale to bypass the traditional fee structure. The global SWF report from March 4th noted that sovereign investors deployed over $25 billion in February alone, with a massive focus on United States-based artificial intelligence infrastructure. These are the players who are actually funding the massive data centers and energy projects required for the next decade of computing. They are becoming the primary architects of the physical world. Sovereign wealth funds specifically now account for $15.8 trillion of that $60 trillion total.
It is also worth noting the geopolitical angle here. We have discussed our pro-American and pro-Israel stance on this show before, and you can see that reflected in where this capital is flowing. A lot of this sovereign wealth, especially from the Gulf, is looking for stability and long-term technological leadership, which is why the United States remains the primary destination. Even with the political noise, the depth of our capital markets, and the transparency that organizations like ILPA are pushing for make the United States the only place that can absorb $25 billion in a single month.
And let's not forget the shift into private credit. Daniel mentioned that private credit assets under management reached $2.4 trillion by the end of 2025. In the current environment, LPs love private credit because it sits higher in the capital stack. It is safer than equity, and with interest rates where they are, the returns are actually competitive with what they used to get from risky venture capital. In fact, private credit is now funding about 80% of all leveraged buyouts in the United States and Europe. The banks have essentially been replaced by a group of pension funds and insurance companies.
It is a total transformation of the financial plumbing. But I have to ask, what does this mean for the little guy? There is a lot of talk about the retailization of private equity. We are seeing firms like Blackstone and KKR launch products specifically for wealthy individuals, not just billion-dollar institutions. We touched on this in episode 1502 regarding the rise of the modern family office. Is this a good thing? Or is it just the big funds looking for a new source of dumb money now that the institutional LPs are being so difficult?
That is the multi-billion-dollar question. The industry calls it democratization, but a skeptic might call it exit liquidity. If the big pension funds are demanding their money back and refusing to commit to new funds, the GPs need to find that capital somewhere else. Individual investors are often less sophisticated and don't have the same bargaining power as a CalPERS or a Mubadala. They won't be demanding the ILPA reporting refresh. They might just be happy to have the prestige of being in a big-name fund.
I am always wary when the smart money is heading for the exits, just as the retail money is being invited in. It reminds me of the old saying that if you are at the poker table and you don't know who the sucker is, it is probably you. That said, if these products are structured correctly with enough liquidity and transparency, it could be a way for individuals to access the kind of returns that have been reserved for the ultra-wealthy for decades. But the if in that sentence is doing a lot of heavy lifting.
It really is. The structural constraints of private equity, the long lockup periods, the capital calls, the lack of a secondary market for individuals. Those are hard to solve for someone who might need their money back to buy a house or pay for a medical emergency. The institutional LPs can handle a 15-year horizon because they have a $60 trillion pool of assets to balance it out. A retired dentist in Florida does not have that luxury.
So, if we look at the landscape today, March 24th, 2026, what is the biggest takeaway for someone trying to understand where the economy is headed? To me, it feels like we are moving into an era of accountability, the era of growth at all costs, fueled by zero interest rate policies, is dead, and the LPs are the ones who buried it.
They are the new regulators. Since the formal regulators often struggle to keep up with the complexity of private markets, the LPs have stepped in with their own rules. The ILPA standards are essentially becoming the law of the land by contract rather than by legislation. If you want the capital, you follow the rules. And the rules are now, show us the cash, show us the data, and show us how you are actually adding value to these companies beyond just financial engineering.
I think that is a net positive for the system. It flushes out the fund managers who were just riding a rising tide. Now, you actually have to be a good operator. You have to understand the technology, the supply chains, and the geopolitical risks. You can't just buy a company, load it with debt, and hope to flip it in 3 years. The LPs won't let you.
And the sophistication of these LPs is only going to increase. We are seeing them hire massive teams of data scientists and engineers to analyze their portfolios. Some of the sovereign wealth funds have better internal research departments than the funds they are investing in. They are using AI to track everything from satellite imagery of shipping ports to real-time consumer spending data to verify what their GPs are telling them. They are no longer just passive partners, they are active monitors.
It is a bit of a trust but verify model, leaning heavily on the verify part. I also wonder about the role of private credit as a permanent fixture. If it is now 80% of the buyout market, does that make the financial system more or less stable? On one hand, the risk is spread out across thousands of LPs, rather than being concentrated in a few big banks that could trigger a systemic collapse. On the other hand, we haven't really seen how private credit behaves in a truly deep, prolonged recession.
That is the big unknown. In a traditional bank-led system, the government can step in and provide liquidity to the banks. But if the private credit market freezes up, there is no lender of last resort for 1,000 different pension funds and insurance companies. It could get very messy very quickly. However, the current data suggests that the covenants in these private loans are actually tighter than what we were seeing in the broadly syndicated loan market a few years ago. The LPs are demanding more protection because it is their retirees' money on the line.
It all comes back to that power shift. The person with the money makes the rules. And right now, the LPs have the money, and they are very aware of it. They are no longer the silent partners. They are the architects.
I think we should wrap up with some practical takeaways for the folks listening who might be in this world, whether they are founders or working in finance. First, if you are a founder, you need to understand who your grand LPs are. Your venture capitalist isn't just spending their own money, they are spending a pension fund's money. If that pension fund is demanding DPI, your VC is going to be pushing you for an exit much harder than they were 3 years ago. You need to be exit ready from day one.
Second, transparency is no longer optional. Whether you are a GP or a portfolio company, the ability to provide clean, standardized data is a competitive advantage. If you can make an LP's life easier by fitting into their reporting templates, like the new ILPA refresh, you are much more likely to get their support when things get tough.
And finally, watch the secondaries market. It is the best real-time indicator of what people actually think these private assets are worth. When you see big discounts in the secondaries market, it tells you that the official valuations in the quarterly reports are lagging behind reality. When those two numbers start to converge, that is when you know we have reached a stable bottom. We are expecting over $225 billion in volume there this year, so there will be plenty of data to watch.
This has been a fascinating look at the hidden side of the house. Daniel always has a knack for picking the topics that are bubbling just under the surface of the mainstream headlines. It is the plumbing that matters, even if it isn't as flashy as the latest AI chatbot.
Speaking of plumbing, big thanks to Modal for providing the GPU credits that power this show. They are the infrastructure that makes this collaboration possible.
And thanks as always to our producer, Hilbert Flumingtop, for keeping us on track and making sure we don't wander too far into the weeds, though I think we stayed pretty disciplined today.
For a donkey and a sloth, I think we covered a lot of ground. If you are finding these deep dives useful, the best thing you could do is leave us a review on Apple Podcasts or Spotify. It actually makes a huge difference in helping other people find the show.
You can also find us at myweirdprompts.com for the full archive and all the links to subscribe. This has been My Weird Prompts. We will see you in the next one.
Catch you later.
This episode was generated using Gemini Flash 3. Text-to-speech engine was Chatterbox.
Thanks for listening to our show, My Weird Prompts, where our thoughts go from slow takes to facts on cue. We change and follow through. My weird prompts, that's the flows from slow